There's all kinds of ways to make money in the market, but there are three main methods to choose from, and they all differ in terms of risk and time. Investing is a passive way to make money in the markets. You don't need to have extensive knowledge on how to read charts, or you need to be at your computer analyzing things every day, and you don't need to learn to be extremely disciplined when it comes to greed and fear, because generally, passive investing is where you hold positions for years and decades. The key here is a long time frame. You basically buy strong, stable stocks or funds that track the major indexes, and you set it and forget it. You let the healthy cycles of the overall markets do the work for you. When you invest in the overall market, over time, you will gain a profit. Maybe not on a day to day, month to month, or even year to year basis, but given enough time, the markets will always rise. The reason why is people will never stop innovating. Companies will always be growing, and if things get ugly, they always, in the end, turn around and become better. Just look at some of the worst economic downturns we've had over the past 100 years. Here's a look at the Dow Jones during the Great Depression that started in 1929. It pretty much lost all of its value during that 10-year time span. But look what eventually happened. Things started to get back on track, and then off we go, breaking new highs and new records for many decades to come. Here's a look at the Dow Jones during our most recent economic crash, the 2008 housing bubble. Now, during this period, the Dow Jones lost 50% of its value. But given enough time, people stepped in, fixed the problem, and got the economy back on track to where we're off breaking new highs and continuing to make new highs for many years. Now, those are extreme examples, but it just shows you that given enough time, the markets will recover. And usually there's some form of financial panic that shakes up the markets every decade. So there is going to be ups and downs. So the key to long-term investing is knowing your goals and objectives. If you don't plan on using the money that is in your long-term portfolio for the next 20 years, well, who cares if the market crashes tomorrow? 20 years is enough time for things to recover and get back on track to record-breaking highs. It's when people give in to greed and fear, touching their long-term portfolio based off of short-term events that will eventually ruin their overall goals and objectives. Think of a long-term portfolio as a bar of soap. The more you touch it, the smaller it's going to get. Just leave it alone, let the market work itself out, because it will. Now, if you are trying to generate enough income to replace your 9-to-5 job, well, investing is just not going to do the trick unless if you have millions of dollars and you're living off the dividends. The goal of investing is to cash out at a much later date. So think 10, 20, 30 years from now. The longer you wait to cash out, the more likely you'll cash out with a bigger profit, as long as you are properly diversified. So I would highly recommend that you set up a meeting with a licensed financial advisor to design a long-term portfolio that is fit for your specific goals and personal situation. Maybe you want to cash out with enough to pay for your kids' college, or maybe a new house 5 years down the road, or enough to retire on. A financial advisor can help put you on the right path and safely and realistically achieve those goals. Now, if you want to be a little bit more active in the markets to try to capture profits from short-term events so you can maybe generate some income and not have to wait years and decades for your money to grow, then swing trading can be an option for you. Swing trading is where you take a position on a stock and you hold it overnight or for a few days or weeks or months before closing out the position. Now, this type of trading does involve more risk, and it requires a little bit more knowledge and skill on how to read charts and financial statements and earnings reports or whatever your strategy entails, but it doesn't require so much time that you need to constantly watch your positions and manage them. The only time you really need is to research the stocks that fit with your strategy, and you can do that in your free time. You can do it on the weekend, whenever you come home from work, whatever. So this is something that you can easily do if you had a full-time job and you wanted to try trading on the side to supplement your income a little bit. Now, day trading is where you open and close positions all during one day. Trades can last for a few seconds, minutes, or hours, but positions are never held overnight. Now, because traders are quickly getting in and getting out of positions in less than a day, their money has less risk from major market events like the economy tanking or interest rate changes or political events, because while, yes, those events can have a drastic impact on the market as soon as that news is released, For traders, since their positions are held just for a short amount of time, their position would most likely be sold before that type of news has a drastic impact on that trader's account. All right. So the main goal of day trading is to capture consistent income day in and day out, much like a normal job where you go to work every day and you get paid for it. And this is possible because oftentimes day traders use a large amount of shares to capture small price fluctuations. So in this example, let's say that a trader bought 1,000 shares at $10.55 at 11:30. And that trader held it for what looks like maybe about until 12:15. So 45 minutes later, they sold all 1,000 shares at $10.65. So they made a 10-cent per share profit. Now, 10-cent profit on 1,000 shares is going to equate to $100. So that trader just made $100 in 45 minutes. So as you can see, day trading is a fast way to provide a little extra income. Or if you're good enough, you can use it as a full-time job. But in order to do it right, it takes a lot of education. And it's going to seem like it's very easy to do and you don't need all this education, because when you were looking at past price performance, you were viewing it in hindsight, and everything will make sense in hindsight. Buy the dip right here, sell at a profit. But it's not going to be that easy. When trading, we're trying to predict the future. And as you know, predicting the future is impossible. So it's through education, analysis, and risk management that traders are able to profit consistently in an inconsistent and unpredictable market. And that's what I've set out to teach. Day trading is what I mainly do, and it's where I get the bulk of my income. I do have a long-term portfolio, and I do swing trade from time to time, but day trading is something I do each and every day the market is open. Now, the main differences, as you might have guessed, between all of these is time. If you hear the term investing or investor, it's typically referring to strategies holding positions for more than a year. And generally, investors don't open and close positions often. If you hear the term trading or trader, it's referring to strategies holding positions for less than a year, and traders open and close many trades within that 1 year. So which method makes the most money, investing or trading? Well, that's a tough question to answer because they are both used for different things. Investing is used to build an account over a long period of time, but you aren't going to make much money when you are first getting started with investing, unless of course you're using a lot of money, such as 6 or 7 figures. But after years of growth and constantly adding to your investments, you'll eventually start seeing your account grow at an exponential rate because of the effect compounding returns has on your investments. And we'll talk more on that on a later lesson, but because it's a gradual process, there is no limit to how much money you can make investing. But with trading, there is a limit to how much you can make, because trading relies heavily on being able to get in and out of positions easily at the prices you want. Every time you buy shares, you buy them from someone who is selling. And every time you sell shares, you sell them to someone who is buying. If we wanted to buy 1,000 shares at $10, well, someone else has to sell their 1,000 shares at $10. Now, this could be one person with 1,000 shares or 1,000 people with one share, but those shares still have to sell at $10. If we wanted to sell our position at $10.20, well, someone has to buy 1,000 shares at $10.20. So it becomes an issue when you start taking very large positions, because there most likely won't be someone on the opposing end to match your position. So again, going back to our example here, if we wanted to buy 1,000 shares at $10, well, 1,000 shares of a $10 stock is going to be a $10,000 position. That's fairly small. There will most likely be someone that has 1,000 shares available to sell to us at that price. But let's say instead we've accumulated this massive account of $1 million, and we want to throw our entire account balance into this one trade and quickly sell for a 10-cent profit. Well, $1 million on a $10 stock is going to be a 100,000 share position, and that is extremely large, and there will most likely not be enough shares available to be sold to us at that specific price. So our buy order probably won't get filled. When you trade, you can only use so much size, and you can only use up to a certain amount of money before you start having trouble getting your orders filled. Now, with trading, it's very common to double your account in 1 year. Let's say that you had a starting balance of $25,000. And then in year one, you turn it into $50,000. Well, I hear people all the time ask, well, why don't you take that $50,000 and then double it the next? And then the next year, you just double it again and then keep doubling and doubling until you're a billionaire. Why don't you do that? Well, it doesn't work that way because of this problem that you have with scalability. You can only buy so many shares without it affecting the price or your orders getting filled. So for a trader, a common strategy is to have a starting balance, and then once it gets up to a certain size, you take the money out and then start over again, using the profits for income while keeping the account proportional to not have problems getting your orders filled. So as we've learned, investing and trading produces results in different ways. Results from investing start off slow, but they have no limitations. Think of it just like a savings account. It starts slow, but over time of constantly adding to it, it grows. While results from trading can be fast, they're going to have limitations. So think of it like a normal job where you get paid every week, but there is a limitation on how much you get paid every week. So if you really want to build a large amount of wealth, it's a good idea to funnel any extra income sources into your long-term investments because there is no limitation to how much you can make with long-term investing. Let's say that you run a small business. Well, any extra income that you get from that small business, you can funnel it into your long-term investments. Let's say you work a 9-to-5 job. Well, anything extra that you can save up, funnel it into your long-term investments. Let's say that you trade. Maybe you trade for a living. Anything extra you make, you funnel it into your long-term investments. Now, if you really want to get the ball rolling, it's best to have multiple sources of income. So let's say that you have a 9-to-5 job, and then maybe on the side, 1 hour a day, you do some day trading, and then on top of that, you run a small, maybe online business or something. All that combined can all be funneled into your long-term investments. And then over time, you're going to accumulate a large amount of wealth to where one day you don't need to do any of these extra income sources and you can live strictly off your long-term investments. Now, before doing all of this, I think there's a certain path you should follow when participating in the market. First, you need to step back and analyze your personal situation because if that is not in order, the stock market should be the last thing on your mind. If you are in an extreme amount of debt, or if you are struggling to pay for basic necessities, or you don't have any savings for emergencies, you need to focus on getting all that in order. And no, the stock market is not going to be your ticket to get you out of that situation. The stock market comes with risk, and risk is something you cannot afford if you are in that situation. Now, once you have your financial situation in order and you have some extra income that you can throw into the market, you should start with creating a long-term plan. The stock market is one of the best ways you can build enough wealth to retire someday. So think of it as a long-term savings account. The more you add to it and the longer you add to it, the more it will grow. Retirement isn't something that you want to mess up, and you're going to thank your future self for starting a long-term portfolio right away. Now, once step number 1 and number 2 are complete, that is when you can start diving into swing or day trading because trading carries more risk and it takes a good bit of education and experience to become good at it. So maybe at first you can just use it to stuff your wallet here and there, and once you get more experience, that is when you can possibly use it to fund most of your income or funnel more money into your long-term investments. All right, so I hope you all learned something. Thank you so much for watching.